World government bonds went through an unrelenting sell-off on Wednesday, and that has driven US 30-year Treasury yields to 5% for the first time since 2007. Those moves could speed up a global slowdown, hurting stocks and corporate bonds.
Hi, my name is Blake Van Wert. I'm a senior here at St. Bonaventure University, and I'm a business management major, and today I'll be talking to you about global bond markets. Now, last year in 2022, the estimated value of the global bond markets was anywhere from 100 trillion to 133 trillion. Now, what is a bond market? The bond market is the total value of outstanding debt issued by 1. Governments, 2. Corporations, and 3. Other entities. Now, globally, the largest bond markets are 1. The US, 2. China, and 3. Japan. Now, as US has been dominating the bond market, this is no longer. Since 2021, China has dumped over $300 billion in US bonds.
Hi, I am Mitchell Mahar. The three largest stock exchange markets in the world are currently the New York Stock Exchange, which is number 1, number 2 being the NASDAQ, and number 3 being the Shanghai Stock Exchange. Now, the reason why the U.S. is number 1 for the stock market is because of their lack of restrictions. So this allows many investors to come in and have trust in the U.S. to allow companies to grow, and also disproportionately, the number of the world's most productive companies are based in the United States. So this makes the stock market very appealing in the U.S. and also makes investors want to invest in companies that are from the United States. So as of today, America is the largest importer in the entire world, and they are currently the second largest exporter in the entire world. Their main imports are mainly have to do with minerals, fuels, and oils, and then also their biggest exports are also refined fuels and petroleum. Now at number 2 for imports, it's China, but they are currently number 1 in exports. Mainly what they import is rice, food, things within that nature, and their biggest exports today is computers and any type of electronical machinery.
My name is Kennedy Haverl, and I'm a sports management and marketing major, and today I'll be talking about GDP per capita. GDP per capita is a universal metric that is used every single day. However, what really is GDP per capita? Countries use this universal metric to see how much economic production value can be attributed to each individual citizen. It can be calculated by dividing the GDP of a nation by its population. Therefore, it helps governments to understand how the economy is growing with its population. For instance, taking a look at this map, it shows the progression of GDP per capita around the world from 1980 to the projected prices in 2028. By watching this map change over the years, you can see that the colors in countries change from darkish red, which means the GDP per capita is under or around 500, to greenish blue, meaning the country's GDP per capita is now around 25,000. So what does this really mean? Countries with a higher GDP per capita tend to be those that are most industrialized. Since new technology and advancements have come out since 1980, our world has evolved carrying a higher GDP with it. Taking a look at this new map, it shows the GDP per capita in the United States is on a higher and steady rate than compared to China. Currently, here in the United States, we have a GDP per capita of around 80,000.
The Euromonitor forecasts global inflation in the range of 6 to 9% in 2022, compared to the annual average of 3.8% from 2001 to 2019. What drives inflation? Bad monetary policy, corporate greed, rising inflation expectations, supply constraints, and demand pressure. But what is bad monetary policy? The central bank printing too much money, which affects devalues the currency relative to the value of the real goods and services, drives up the prices. Corporate greed, what is that? Companies exploiting the public, squeezing higher profits and driving prices up. Rising inflation expectations, a psychological explanation which strangely holds that if the public thinks prices will rise, then that alone can cause prices to rise. Supply constraints, bottlenecks in the economy that create shortage of the key goods, energy, and other commodities, driving prices up.
My name is Evan Tillinghast, and I'm here to talk to you about grow economies or grow countries. One of the fastest economically growing countries on the planet is India. In 2023, the World Bank expects India to outperform all other major economies with a growth of 6.6% compared to the 4.3% of China. India's economy grew at its quickest pace in a year in the April to June quarter. GDP has expanded 7.8 on the annual basis in the quarter, accelerating from 6.1% growth recorded in 3 months to the end of March. The world's fifth largest growing economy is expected to grow 6% in the fiscal year ending March 31st, 2024, according to a survey taken by the Indian Central Bank this month. The Indian economy is expected to grow from 6.1 from 2023 to 6.3 in 2024.
Hello, my name is Mia Clona, and I'm a senior marketing major here at St. Bonaventure. Today I'm going to be talking about China versus the United States market. For decades, the Chinese and U.S. market have seen substantial progression and growth throughout the years. The United States Stock Exchange are currently larger than China's. However, this always has potential to change. According to recent studies, in September 2022, the New York State Stock Exchange had a market cap of 28.8 trillion, while China's Shanghai Stock Exchange had a market cap of 7.05 trillion. In the United States, institutional investors dominate the market. These are financial markets that are commonly known as the buy side, meaning that they are essentially money managers. This is where they would then distribute money across various assets and trading strategies. Institutional investors invest on behalf of the individual investors or shareholders and are typically large corporations that are invested in large quantities. While China has strong institutional investors, they dominate the market in retail investors. Essentially, retail investors are typically individuals who manage their own investments, which are typically invested in smaller quantities rather than larger quantities that we saw with the institutional. This would include individuals buying and selling securities such as mutual funds, stocks, and exchange-traded funds. And as you can see on this graph, the United States does dominate in the market, but however, they do fluctuate with each other. Thank you.